Hey everyone, and welcome back to Boss Economic World, where we slice through the jargon and get to the real story behind the numbers. Alright, picture this, you're on a long family road trip. The dad, let's call him Jerome, is driving. For the last 2 years, he's had his foot slammed on the brake to avoid a fiery crash called inflation. It's been a bumpy, nauseating ride for everyone. Now, the road ahead looks a little clearer, and he's gently started to ease off the brake, tapping the gas just a little bit. But suddenly, the car is filled with arguments. One kid in the back is yelling, "Dad, we're slowing down too much. We'll never get there. My legs are cramping up." That's the job market. At the same time, your other kid in the passenger seat is pointing at the fuel gauge, screaming, "Don't you dare. We're still burning through gas way too fast. We'll get stranded in the desert." That's the inflation hawks. And to top it all off? The GPS has gone completely dark, and a certain former president is calling in via a crackly speakerphone, yelling that Jerome is the worst driver in history and should be flooring it. That, my friends, is a pretty accurate picture of the US Federal Reserve on October 30th, 2025. It's a mess. And today, we're going to untangle it. Let's get into it. So, the big news that dropped yesterday was that the Federal Open Market Committee, or FOMC, that's the Fed's big shot panel that sets interest rates, voted to cut their key interest rate, the federal funds rate, by another quarter of a percentage point. This brings the target range down to 3.75% to 4%. Now, on the surface, that sounds great, right? A rate cut. It's the second one in a row after a brutal hiking cycle that took rates to a 2-decade high. A cut is supposed to be the Fed saying, "Okay, economy, we're going to make it cheaper for you to borrow money. Go buy a house, expand your business, live a little." It's the financial equivalent of the bar announcing a happy hour. And for a moment, Wall Street thought the party was on. But then, Fed Chair Jerome Powell walked up to the microphone for his press conference, and instead of handing out free drinks, he basically flipped on the lights, turned off the music, and told everyone to go home. In what was, for a central banker, the equivalent of a public shouting match, Powell used his opening statement. The man didn't even wait for a question to throw a giant bucket of ice water on the market's expectations. He said, and I'm quoting the key part here, "A further reduction in the policy rate at the December meeting is not a foregone conclusion, far from it." Let me translate that from Fed speak into English. All you traders betting your bonuses on another Christmas present from us in December? Don't. We might just give you a lump of coal. The market's reaction was instantaneous and brutal. It was a digital gasp. The price of US Treasury bonds fell off a cliff, their biggest drop in almost 5 months. When bond prices fall, their yields go up. The 10-year Treasury yield, which is a benchmark for everything from mortgage rates to corporate loans, shot back above 4%. The betting odds on Wall Street, which we track using Fed funds futures, completely flipped. Before Powell spoke, another cut in December was seen as a 90% probability, a virtual certainty. After he spoke, those odds plummeted to around 50-50. A coin toss. Pooja Sriram over at Barclays basically said what everyone was thinking: "We did not expect there would be such a strong pushback." It was a classic Powell pivot, but this time, it was a pivot away from the pivot everyone expected. So, the big question is, why? Why cut rates with one hand and then threaten to stop with the other? To understand that, you have to understand the civil war that's currently raging inside the marble halls of the Federal Reserve. The Fed isn't one person. It's a committee. And right now, that committee is more divided than a family arguing over the thermostat. The vote to cut rates was 10-2. That doesn't sound too bad, until you look at who dissented. For the first time in 6 years, there were dissents in both directions. You had one member, a dove, who wanted a bigger, 50 basis point cut. They're looking at the job market and screaming, "The engine is sputtering. We need more gas, now." And you had another member, a hawk, who wanted to hold rates steady. They're looking at the inflation gauge and yelling, "The engine is still overheating. Let it cool down." This is the core conflict that defines the global economy in late 2025, the tug-of-war between supporting jobs and fighting inflation. Let's break down both sides. On the side of team jobs, these guys are looking at the labor market with serious concern. After the post-pandemic hiring frenzy, things have cooled down a lot. Remember, the Fed's rate hikes were designed to do this. They wanted to slow down the economy to kill inflation. The problem is, it's a bit like trying to land a 747 on an aircraft carrier. A soft landing is possible, but the risk of a hard landing, a full-blown recession, is terrifyingly real. The doves are seeing warning signs everywhere. Hiring slowdown, the last official jobs report we got before the government shut down, which we'll get to, showed a marked slowdown. Corporate layoffs, we're not seeing the mass layoffs of a crisis, but the announcements are piling up. Amazon just announced a headcount reduction in its corporate division. General Motors is offering buyouts to white-collar workers. The tech darlings of the early 2020s, like Applied Materials, are trimming fat. It's a slow bleed, but it's a bleed nonetheless. Immigration's impact, this is a tricky one. President Trump's aggressive crackdown on immigration has constricted the supply of labor. Fewer workers means companies have to fight harder for the ones that are here. Powell actually acknowledged this, but he argues, and this is key to his personal stance, that even if it's a supply issue, weak demand is also playing a role. He believes the Fed's tools can still help by boosting that demand side. He basically said, I see people losing their jobs, and it's my job to care about that. He's firmly on team jobs, but as the driver of the car, he has to listen to everyone. On the side of team inflation, these policymakers are haunted by the ghost of the 1970s. They have PTSD, post-traumatic 70s disorder. Back then, the Fed, under a guy named Arthur Burns, saw inflation coming down and declared victory way too early. They cut rates, and inflation came roaring back even worse than before, leading to a decade of economic misery. The hawks today look at our current situation and see a terrifying echo. Their evidence? Sticky services inflation. Yes, the price of goods, your TV, your furniture, the stuff you buy on Amazon, has come down. That was the easy part. But the price of services, your haircut, your car repair, your restaurant meal, is proving stubbornly high. We have a name for this, supercore inflation. And that number is stuck at a hot and bothered 3.2%, way above the Fed's 2% target. It's like a weed you keep pulling, but the root is still in the ground. Wage growth, while it is cool from the crazy 6% growth we saw a few years ago, wage growth is still running around 4.5%. That's great for workers in the short term, but economists worry that it's too high to be consistent with 2% inflation in the long run. The hawks fear this could fuel another wage price spiral. Complacency risk, their biggest fear is the one Powell just acted on. If the Fed signals it's done fighting, everyone, consumers, businesses, investors, will start acting like inflation is no longer a problem. Businesses will raise prices more confidently, workers will demand higher wages, and the inflation dragon we thought we had slayed will wake up and breathe fire all over again. So you have this deep, philosophical divide. One camp fears doing too little and causing a recession. The other fears doing too much and reigniting inflation. And Jerome Powell is stuck right in the middle. Now, imagine trying to settle this incredibly high-stakes argument, while blindfolded. That's what the government shutdown has done to the federal. Since early October, the agencies that produce the most critical economic data, the Bureau of Labor Statistics, the Bureau of Economic Analysis, have been closed. This is a catastrophe for economic policy. It means we have no new official data on the Consumer Price Index, our main measure of inflation. The Personal Consumption Expenditures Price Index, the Fed's preferred measure of inflation. The Monthly Jobs Report, the single most important snapshot of the labor market. Job openings and labor turnover survey, the data that tells us how many jobs are available. The Fed is essentially flying a multi-trillion-dollar economic airplane without a dashboard. They have no altimeter, no airspeed indicator, no fuel gauge. This isn't just inconvenient, it's dangerous. So, what are they doing? They're scrambling. They're forced to rely on a patchwork of private sector and alternative data. Instead of the official jobs report, they're looking at payroll processor ADP's private report. Instead of the official JOLTS data, they're looking at hiring trends from LinkedIn and Indeed. They're obsessively tracking weekly state-level filings for unemployment insurance, which, as Powell pointed out, still look relatively low, giving him some ammunition to calm the job loss fears. They're listening to corporate earnings calls, trying to read the tea leaves in what CEOs from Walmart to Microsoft are saying about the consumer. But all of this data is incomplete, sometimes contradictory, and often less reliable. This data vacuum only hardens the divide inside the federal. When you don't have a clear, trusted set of facts, everyone just retreats to their own prior beliefs. The doves see weakness in the anecdotal data, and the hawks see resilience. The uncertainty gives both sides license to say, see? I'm right. As if a deep internal division and a data blackout weren't enough, there's one more massive factor at play, the political pressure cooker. President Donald Trump has been on a relentless campaign against Jerome Powell, a man he himself appointed. Throughout 2025, he has publicly and loudly criticized the Fed for not cutting rates faster and more aggressively. He sees high interest rates as a direct threat to his economic agenda and, frankly, his political fortunes. Powell's pushback against a December cut is a direct defiance of the White House. This is more than just a policy disagreement, it's a battle over the future of the central bank's independence, which is the bedrock of the U.S. financial system's credibility. The whole world trusts the U.S. dollar because it believes the Fed makes decisions based on economic data, not political threats. Trump is challenging that belief daily. And this is where it gets really interesting for the year ahead. Powell's term as Fed chair ends in May 2026. That's just around the corner. Trump will get to appoint his replacement. Joe Bruswalis, a sharp economist at RSM, said he expects dissents to be a near-permanent feature going forward. In 2026, the roster of who gets to vote on the FOMC rotates. Combine that with a new Fed chair potentially appointed by Trump, someone who might be chosen specifically for their loyalty and their willingness to slash rates, and the entire character of the Fed could change overnight. We could be looking at a Fed that is far more dovish, far more tolerant of inflation, and far more responsive to political whims. This is the long-term risk that keeps serious economists and global investors up at night. Powell's current tightrope walk isn't just about navigating the next few months, it's about trying to preserve the institution of the Fed itself before he potentially has to hand over the keys. Okay, let's bring this all home. A civil war at the Fed, a data blackout, a political storm, why should you care? Because this fight directly impacts your wallet. Your mortgage and loans. Powell's tough talk means the cost of borrowing isn't going to get dramatically cheaper anytime soon. That 10-year Treasury yield that spiked? It influences mortgage rates. So, if you were hoping for a quick return to 3% mortgages, you need to shelve that dream for a while. The same goes for car loans and credit card rates. Your job, the Fed's balancing act, is a direct gamble on your livelihood. If the doves are right and the Fed waits too long to cut, the hiring slowdown could turn into a full-blown layoff wave. If the hawks are right and they cut too soon, your next pay raise could be completely eaten up by resurgent inflation. Your 401k and investments. The stock market hates uncertainty. This internal Fed conflict and Powell's surprising message created a huge dose of it. Expect more volatility. The market wants a clear, predictable path from the Federal. Right now, the path looks like a winding mountain road in a thick fog. So, what should you watch for? The December 9th, 10 meeting is now the Super Bowl of economics. Every piece of data, official or otherwise, that comes out between now and then will be scrutinized to death. But most importantly, listen to what the different Fed officials are saying. Don't just listen to Powell. Listen to the governors, the regional Fed presidents. They are the voices of this civil war, and their words will give you the best clues as to which side is winning. The Fed is trying to land a jumbo jet in a hurricane with a broken dashboard while the pilot and co-pilot are arguing. Jerome Powell is trying to be the calm captain, but his crew is mutinous. His message yesterday was clear: I'm still the one flying this plane, and I will put it into a holding pattern if I have to. The question is whether he can maintain control of the cockpit long enough to find a safe runway. That's the real story behind the headlines. Stay sharp, stay informed, and don't take your eyes off the Fed.